The Trump effect on financial markets continues, this time with a massive shift in U.S. energy policy. Trump has officially declared a national energy emergency, giving special powers to accelerate energy production and distribution via deregulation. So what stocks will this have the largest impact on? I searched through all major U.S. energy stocks and took a look at their financials and business model. Today, I'm going to share the top 5 energy stocks that will benefit from this new energy policy. Many of these are high-quality, high-yield dividend growth stocks. But first, let's dive into exactly what these policy shifts are. Trump's new executive order streamlines the regulation process, with estimates saying that it could potentially save the oil and gas industry $87 billion annually from regulatory delays on projects. Other notable points for the purpose of this video include going back to his first-term strategy of opening up Alaska for oil and gas drilling with accelerated permits. And given that his term just started, we might actually see this get done this time. Don't believe me? Let's hear from President Trump himself. He just spoke at the World Economic Forum in Davos, and here's what he had to say about energy.
National energy emergency to unlock the liquid gold under our feet and pave the way for rapid approvals of new energy infrastructure. The United States has the largest amount of oil and gas of any country on earth, and we're going to use it. Not only will this reduce the cost of virtually all goods and services, it'll make the United States a manufacturing superpower and the world capital of artificial intelligence and crypto.
This increased energy production has a twofold strategy. One, to meet the demand needed for these new massive AI data centers under construction so that the US can be the leader. Those are also getting accelerated regulatory approval like we just saw with the Stargate news. And Trump even mentioned that he's giving approval for directly attached energy generation facilities. So that means these new AI data centers will have their own source of energy and will be largely off the traditional grid. AI data centers are a massive energy suck, with some estimates arguing we need to at least double US energy generation. The other goal is to lower energy cost. If you don't believe me, Trump outright says the goal is to drive down the price of oil and gas.
I'd like to see them come down a lot, and oil prices will come down. And when oil prices come down, everything's going to be cheaper for the American people and actually for the world, but for the American people. So I'd like to see oil prices come down. And when the energy comes down, that's going to knock out a lot of the inflation. That's going to automatically bring the interest rates down.
So we have massive increases in production, expected growth of demand, and a goal of lowering oil prices. It's at this point where the energy stock analysis gets really, really interesting. Your initial thoughts might be just buy oil and gas stocks. Go to the big names like ExxonMobil or Chevron. I think that's the wrong approach, especially right now. Why, you may ask? Well, the profits of these large oil producers largely depend on the commodity price of oil and gas. As you can see, Exxon has seen their earnings fluctuate massively over the past few years, and that's because energy prices have fluctuated massively. We saw crazy lows during the pandemic shutdowns, and then very high oil prices after demand started reaching new highs, and supply was not able to catch up. This is one of those classic markets where it's that supply and demand principle that determines the price. During those extremely low prices, ExxonMobil was actually losing money. And then during 2022, they were making record profits, and they still today are at very profitable levels. For context, in fiscal 2022, they generated $76.8 billion of cash from operations and $58.39 billion of free cash flow. Now, don't get me wrong, ExxonMobil is a great business, and it's a core position in my personal dividend growth stock portfolio. I've had great returns with a dividend yield on cost of around 10%. I'm definitely not planning on selling my ExxonMobil stock. It's around 9% of my portfolio, but I do not think the oil producers are the play given this environment where the price of oil is likely to go down. That is going to decrease the profit margin at large oil producers like ExxonMobil and Chevron. Now, you could argue that maybe increased volumes will help them grow, but there is no doubt that margins will likely decrease from here. So which energy stocks are the ones set to benefit? Today, I'm going to share the top 5 with my logic behind them and a brief stock analysis for each. As I mentioned, some of these are high yield, reliable dividend payers with dividends that regularly grow over time. If you stick around to the end of the video, I'm going to share which other sectors outside of energy may benefit from this affordable, abundant energy environment. With that said, let's roll the intro. My name is Zach. This is Dividend Data, and you should leave a like and subscribe to the channel if you enjoyed the video. Throughout, I will be using the best stock research tool for dividend-focused investors, which is available at dividenddata.com. Here you get access to great data visualizations that give you a full picture look at the quality of the financials behind the stock, and an AI research analyst that you can ask questions to learn anything about a business. That includes screening for stocks based on hundreds of different metrics, and even using AI-powered search to get insight on breaking news stories that impact financial markets, such as Trump's executive orders around U.S. energy policy. So if you want to try out dividenddata.com, the best time is now. We are exclusively offering a 7-day free trial, which is only available using the link in the description and pinned comment of this video. So if you want, try it out by clicking the link below. All right, so now let's get to the top 5 stocks that will benefit from this new energy policy. The first 3 I'm sharing, in my opinion, are the best of a sector I think will do well, and that is midstream oil and gas pipelines. And the reason why is that these businesses are somewhat shielded from the direct impacts of lower energy prices. These pipelines make their money through transportation fees, storage fees, processing fees, and long-term contracts. And given this new environment, pipelines are likely to get much more increased volume, and we're also likely to get expansion and new construction of pipelines. Even with these AI data centers, which are going to be a big part of new demand, natural gas is likely going to be the largest source of energy generation. 41% of total U.S. energy generation is natural gas. Well, for stock number 1, I have Enterprise Product Partners, ticker symbol EPD. However, what you might notice is that this has a little LP next to its name, the limited partnership. I'm going to explain what that means because the 3 pipeline stocks I'm sharing today are all limited partnerships. Now, what's different about these stocks is that they pay distributions instead of dividends, but from the perspective of an individual shareholder, the experience is basically the same. They also have very high payout ratios on paper, but that's because they're actually mandated to pay out most of their income to investors. So what that means is the 3 stocks I'm going to share with you today are big dividend payers. The other thing you need to know is that you'll get a K1 for your taxes. Some people don't like this. I've done it for a few years. It's pretty simple. You just check another box when you do your taxes. But if you own a bunch of these stocks, it may start to get confusing. I personally own EPD in my dividend growth stock portfolio. I've gotten a very good return on it, and I've reinvested all my dividends to the point where my yield on my initial cost basis is now just under 15%. But let's take a look at EPD stock overall. As you can see, they have had growing earnings per share over the long term, and their stock price has largely followed that exact same pattern of growth. However, they did get very overvalued in 2014, and then they had a very large sell-off when most oil and gas stocks did in 2020. That's when I bought. And now you could say it's actually probably reasonably valued. It's not cheap, it's not expensive. The current dividend yield is 6.36%. And if we look at their dividend payment, they've been consistently increasing it for decades. It's a quarterly dividend payer. The 10-year compound annual growth rate of the dividend is 3.76%. As you can see, they used to increase it every single payment, but now they do it every other payment. And they do have a high but sustainable payout ratio, and this is normal in MLP. If we look at other key financials, you can see that their free cash flow per share has been growing over time. However, they did increase capital expenditures recently, lowering their free cash flow. And I think you should expect their investment probably to continue increasing given this new energy environment. What's nice about EPD also is they're at a stage where they're no longer issuing large amounts of shares. That means they're not diluting shareholders to raise capital. If we look at EPD's dividend yield, you can see that it's currently around 6.2%, and it has been going down since the stock price has been going up lately. If you're a new dividend investor, you need to remember that dividend yield and price, they have an inverted relationship. So in terms of dividend yield on cost, 2020 was really the best time to buy because the price was so depressed. And the price you pay for a stock like this really matters so much. For example, this is a stock that since it went public in 1998, it has had a 3,500% total return. However, if you bought the stock in 2014 and held it all the way through 2022, you would have had virtually no gain. But over the past 3 years, it has had a 73.8% total return. And if you had bought from 2020, you would be doing even better. In my personal EPD position, I have a 135% total return. I bought it during 2020. So if we look at EPD stock right now, I wouldn't say it's cheap and I wouldn't say it's expensive, but it is a high quality stock set to grow in this current environment. And the question really is how much they can grow earnings. If the answer is a lot, then now may be an interesting time to buy. Stock number 2 is MPLX. This is another pipeline limited partnership. They operate pipelines for both oil and natural gas. MPLX is a stock I've been covering a lot recently, and I am considering adding a position myself, although I do not currently own the stock. In recent years, they have been growing earnings pretty high, and they have a current 7.37% dividend yield. What's nice about MPLX is they have much higher dividend growth than EPD. In fact, they have a 9.6% 10-year compound annual growth rate of the dividend, and the 3-year compound annual growth rate is 10.7%. The most recent dividend increase was 12.53%. Recently, they've been increasing it once a year, and this is a quarterly dividend payer. It does have a high but sustainable payout ratio based on both free cash flow and net income. And as I mentioned, this is a limited partnership, and those are mandated to pay out the majority of the income as dividends. If we look at other key financials, free cash flow per share has been growing in recent years and remains very high. The 5-year compound annual growth rate of free cash flow per share is 30.18%. However, to be more fair, the 3-year CAGR is 11%. This company is also mature and does not dilute shareholders any longer. In fact, they've been slowly repurchasing shares. If we look at MPLX's dividend yield over time, you can see that has gone down recently as the price has gone up. However, during 2020, you could have gotten a 15% and even 25 or 30% dividend yield, which is just absurd. I wish I had this on my radar then, because I would have just loaded up the boat. And again, these are the types of stocks where the price you pay matters so much. If you bought it in 2014 or 15 when most pipeline stocks were really overvalued, then you would have seen no return for nearly a decade. But if you bought it 5 years ago, right before the pandemic crash, you would have had a 263% total return. That would have been even better from those pandemic lows. Stock number 3 is Hess Midstream Limited Partnership, ticker symbol HESM. This is another pipeline company. They've had slow growing earnings in recent years, and the stock price has largely followed suit. This is a smaller company compared to EPD and MPLX. The current dividend yield is 6.71%. It is a quarterly dividend payer that increases their dividend every single payment. The 5-year compound annual growth rate of the dividend is 10.73%. Recently, they've been increasing it 2.5% a quarter, and this is very sustainable based on free cash flow and net income. And I haven't owned HESM stock or done deep research on the company before, but their free cash flow has gotten pretty ridiculous. There were points where they were trading at a 1 price to free cash flow ratio. And when fiscal 2023 ended, they were still trading at a 2.76 free cash flow ratio. So this is actually another one I'm going to add to my watch list, because with this kind of free cash flow, their capacity to pay and grow their dividend is much higher. And this company's dividend yield is lower since the price has gone up recently, which seems to be a trend among pipeline stocks right now. But over the past few years, you could have gotten a 7.5%, 8% dividend yield. And in 2020, that got as high as 10% and even up to 27% during the COVID crash. The stock has had very good total return over the past 5 years at 165.7%. It is important to note that this company is consistently raising capital through issuing new shares. That's likely to fund a lot of their investments. So you are being diluted as a shareholder, but this is a growing company. And if you go to their website, you can see a map of their pipelines. And by the way, when you're doing deeper research on these companies, it's always a good idea to check out their investor relations page, whether it's to verify data or read their annual report straight from the source. So Hess Midstream is one that I'm now deeply looking at, especially after making this video. And then for stock number 4, I'm going to move away from the pipeline business. And this one is very different. For stock number 4, I have Texas Pacific Land Corporation, ticker symbol TPL. And this company doesn't operate pipelines. They don't drill for oil. What they do is own the rights to land, and they get royalties on the oil and gas produced on that land. They also own a lot of water rights and get royalties based on that. So what's nice about this company is they will benefit from increased volumes and won't necessarily have to worry as much about the volatility of that price and the margins. Now, this is a much lower yield dividend stock at 0.46%. That's because it's trading at a relatively high historical price. And frankly, in my opinion, this is the number one oil and gas stock I would want to buy in terms of business model. And that's because they don't have to front any of the risk or cost. Their margins are nuts. They have 92% gross margins. Their capital expenditures are next to nothing. This company just rakes in cash. They are drowning in free cash flow, and they use that to build up their balance sheet and then pay large dividends and buy back stock. They currently have over $500 million in cash on hand and deeply negative net debt. Free cash flow per share is growing at a 30% 10-year compound annual growth rate. And they have a quarterly base dividend, which they increase on an annual basis. That just increased by 36%. But what you'll notice here is they also do these large special dividend payments. So even though I mentioned they have a low dividend yield, it's actually in reality much higher than that when you include the special dividends. And when you go and look at their cash flow statement, you can see they build up their balance sheet and then they'll do these big dividend drops where it's $177 million, which is a $150 million increase from their normal base dividend. You can see in 2024, they did a $10 dividend per share, and they do these on top of that quarterly dividend, and they regularly buy back stock as well. So again, this stock always has a low yield based on their current dividend, but when you include those special dividends, it gets much higher. And again, imagine buying this in 2020 at a 4% dividend yield. Oh my God, that would have been awesome. I wish I had it on my radar at the time. Since 1990, the stock has had over an 87,000% total return. Over the past 5 years, it's had a 530% total return. And that's before the pandemic crash. So I've got my eye on the stock. I may just bite the bullet and buy an initial position at some point. But if there's ever a big oil crash, I'm going to load the boat on the stock. And then for stock number 5, I have Berkshire Hathaway, ticker symbol BRK-A for the Class A share or BRK-B for the cheaper Class B share. And you might say, Zach, this isn't an energy stock. Well, it kinda is. They own Berkshire Hathaway Energy, which is one of the largest energy businesses in the United States. Pretty sure they're the largest infrastructure company in the US. They own the Northern Natural Gas Pipeline, which is one of the largest pipelines in the United States. And I kind of consider this to be a sneaky, high-quality play in the energy sector. If you don't know, Berkshire Hathaway is Warren Buffett's investment company, and they've had just one of the craziest performance track records. Kind of difficult to argue that this isn't the best-run financial asset in the world when you consider they've been doing it decade after decade after decade. This is not a dividend payer, but this is a business that continually grows over time. They generate a lot of free cash flow, have an insane base of assets and investments that includes a gigantic public stock portfolio, but they are also in a very strong financial position to potentially invest and deploy capital in this energy infrastructure. They have $325.2 billion of cash and short-term investments. $288 billion of those are in treasury bills, where Buffett is getting 4 to 5% risk-free on his investment. However, in my opinion, and a lot of those following the market, it's likely that interest rates will come down over the coming years, and Buffett may not be getting that risk-free return, in which case he may say, what do I do with all this money? And in my opinion, one of the safest choices for him likely is to just invest in Berkshire Hathaway Energy and expand their pipelines. And especially when you consider that Warren Buffett's already named successor, Greg Abel, runs Berkshire Hathaway Energy. So it all kind of seems to make sense. And hey, even if that doesn't play out, this current energy environment will at least give some tailwinds to that business for Berkshire Hathaway, which is an extremely safe, reliable, high-growth stock. So those are what I would consider to be the top 5 energy stocks to benefit from Trump's economic policies. But there will be a lot of other industries outside of energy which could benefit from this as well. For example, we have the obvious, which is AI, which needs all of this energy to power the infrastructure of the future with their new data centers. So that obviously helps big tech. And as AI improves, that will go through every single industry as well. So a massive growth wave there. And then you have other more traditional industries which benefit from lower oil and gas prices as well. For example, you have transportation, so any company where you're shipping stuff around a lot. One example of that might be Amazon, maybe UPS. You have large-scale manufacturing companies which rely on energy to power their facilities. You have airlines when it comes to jet fuel. You have agriculture for powering their equipment. You have retail, which is more indirect in that they sell products which are shipped around, so that can lower the cost of goods sold. That would even apply to consumer packaged goods companies with large distribution, like perhaps Coca-Cola or PepsiCo. There is a lot of trucking those products around. You have chemicals and plastics, which, hey, that might actually help out that business for something like ExxonMobil. They have a very large chemicals business. And then really any energy-intensive industry. If you found this video to be interesting, please leave a like, comment, and subscribe to the channel. And more importantly, if you found the tool I'm using throughout to be interesting, then sign up at dividenddata.com. You can get access to everything I showed today. And the best time to join is now because I'm doing a limited offer of a 7-day free trial. You have to use the link in the description and pinned comment of the video. So click the link below and try it out at no risk. With that said, I'll see you in the next video.